This is Satya Pradhuman of Cirrus Research. Welcome to our quarterly conference call. Today, I'm going to walk through the firm's outlook, how we're framing this current market environment. A lot of this is taken from the quarterly report, the Cirrus Dispatch. The title of that report was Risk Assets Matter as War, Pandemic, and the Fed's Hammer collide with market discounting. So these are incredibly dramatic times. And to put this in context, one of our recent titles was recently labeled War, Pandemic, and the Fog of Inflation. Yes, this is not 1969. This is not 1918, but it's 2022. Without being hyperbolic, these are extreme times. All of those terms really apply to this moment. And it's been in some ways fairly impressive to see how investors or the markets have really sort of navigated the moment. We've had some dramatic moments, some sharp pullbacks, but net, it's been fairly even keeled given the significant headline risks we're all facing. We'll address today in this call how to sort of reconcile these dramatic moments and yet not still hide assets under our mattresses and remain in ready position. The assumptions going into this: one, we're going to continue to face interest rate risks. The Fed chatter will remain dominant across the airwaves. The inflation data continues to jump. Initially, it was due to the global sort of like wind down through to the pandemic, and then the rush to reopen as the pandemic began to roll off in a very uneven fashion. The latest shutdown in the COVID-related moment in Shanghai is likely to continue to hound the already stressed supply chain issues we've been facing and potentially exacerbate what we've seen to date. In addition, the invasion of Ukraine, which is just awful. It's just an awful moment. We're all witnessing this 24/7. These are elements, really out of our control and likely to remain in place, to sort of net it out. Inflation fears, higher commodity prices, Fed action, and still COVID strains. So this leads us to really, the barbell posture that we are framing in this environment. The idea is to own higher quality firms, higher earnings visibility, as the current profit cycle, we think, given all of these elements we've just described, they'll likely force the profit cycle to peak and therefore roll over. And the bottom line is that this profit cycle starts to slow, higher quality firms will continue to outperform. We've made this case in the last year, and to date, it's actually worked quite well. We have seen higher quality firms really dominate as the innovation shares have broken sharply. And now, I guess the question is, how do you reconcile this with a world of higher commodity prices, one that's likely to be higher for longer? Okay, let's get started. The key highlights in the report: the pullback in speculation, extreme risk aversion point to adding risk assets, yet high market multiples temper absolute returns. The barbelled posture I've described, this is clearly warranted as the profit cycle. It's effectively going to collide with inflation and the Fed, as we frame it, the Fed's hammer. The quality bias should be dominant, and importantly, discounting among these firms remain in place. And then finally, I'll probably touch on a little bit of the infrastructure linkage to this commodity moment. So let's start with the cover chart and what we framed out as a diagram, and that is, this barbell posture effectively forces us to deal or balance the idea of quality and quality growth companies, where they benefit from generally peaking profit cycles, the fears of the Fed tightening to slow down growth, margin pressures. This is this was not surprising, but it just got exacerbated really by the move in commodities. Uh, on the other hand, if you're going to see commodity prices rise, remain higher for longer, guess what? Uh, Energy sectors, industrial sectors, they start to matter. And in addition to that, we're also likely to see this ongoing sort of challenge for the very expensive innovation shares that had run their course coming out of the pandemic. In many ways, I think what has allowed the market to not really face that sort of dramatic 20, 30% sort of moment like the unwind of the internet bubble was the idea that in the last 12, 18 months, we had already begun to see a quiet, slow and steady breaking down of some of the most extreme multiples, the extreme tail risk in the market. So in some ways, what's been going on is the rotation underway since really early 2021. We had begun to witness some of the focus come back to sort of a cyclical reopening moment, but that really forced the break in the highest multiples, which would have been the sort of risk, the critical risk in this current period. So in some ways, one of our favorite profiles is to use one of the ARC innovation funds, or the next generation internet product. And if you look at that portfolio over time, typically it sells somewhere between a 4 to 6 times on an EV to sales basis. During the early stages of the pandemic, these multiples clearly started to climb. They went up to about 14, 15 times on an EV to sales. Mind you, the market multiples, the premium has been generally a double, but not a quintuple to market multiples. But that's really where we were by late 2020. Since then, we've seen that reverse sharply, and currently we've come back all the way down to about a 6 times. At the heart of this, though, my instincts are this is probably not over. This idea, unless we were to say we're completely confident with what the Fed has done, interest rate risk will remain sort of this sort of like deadweight loss for some of the most aggressive growth stocks. We think that credit cost of capital issues are going to remain paramount, and really that's a very tough window for great growth companies to work that are so highly speculative. This is another example of really our innovation shares. When we look at this, the performance of small cap, large cap innovation shares, they've all generally rolled over for about 18, 20 months. So we think that this has been one of the key reasons as to why you've had a natural offset to the system as some of the most extreme price shares really correct for over 12, 18 months. Bottom line, what we're also recognizing in our own proprietary model work, our risk posture model over the last 4 or 5 months has signaled this sort of like collapse in risk taking. Risk appetites are an interesting sort of framework. They are generally contrary in nature. In other words, when investors love risk, when risk appetites are sprung very high, you tend to find that expected returns the subsequent 6, 12 months tend to be lower. When risk aversion is extreme, when people are quite scared and nervous, as those risk appetites bottom and they begin to stabilize, the subsequent 6, 12-month returns are well above average. So what we've got right now is this conflicting pattern. We've got tons of headline risk. We're clearly not out of the woods, and yet the market is clearly pricing in risk. And so as risk appetites start to bottom, we still think that this is an important moment to really focus on selectively how to navigate the equity markets. One important thing to bear in mind is that in our own asset allocation work, which is somewhat consistent with what I've just said, the curious reading between our stock bond allocation, the allocation in the last 3 months has spiked all the way up to like a 60, 70% reading to equities. The long run normal for that is typically a 48% equity exposure. And, we have a challenge sort of like trying to explain that, but underneath it is the idea that what you've got here is a marketplace that's potentially more nervous about bonds than stocks. And the other element, though, is that as rates begin to shift higher, bear in mind, we're not in the 80s or the 70s where the absolute rates picture is so damning. In other words, we are nervous. It's rattling the system where we really enjoyed a terribly easy cost of funding. These numbers are moving up, but the rates that we're debating right now, does 2.5 on the 10-year go to 3 or 3.5? Those are still well within reason that allows companies to function quite well. So in some ways, we think that remaining focused on risk assets matter here. I think clearly we have to be selective. One important thing to consider is the market multiples on an absolute basis. We're always busy looking at relatives because we're much more focused on where are the opportunities in the marketplace. But stepping back for a second at a higher level, the reality is that we are looking at in critical markets like US, Europe, these markets are selling at 20, 30 year highs, even with the sort of noise and pullbacks we've seen. Part of that has been driven by the 30, 40-year collapse in interest rates and inflation. And so in those worlds, equity markets really, really surge. And so while we're going through this sort of nervous headline stuff and risk appetites are changing, the reality is that if we're moving to a whole new interest rate regime, multiples are likely to continue to sort of like remain stagnant or potentially even come down further. So in these kinds of markets, when you're looking at an earnings driven market, that's a lower returns market. It's still probably a favorable place compared to bonds. But I think we just got to recognize this may not be the 10, 15% return kind of framework that a lot of clients have gotten used to, or your clients have gotten used to. A look at market multiples are high. In fact, if you look at the subsector of technology, those numbers are also still quite high. They're not at the levels when you adjust them for the market. They're not at the levels as we saw back in 2000, like the internet bubble. However, they still are at the upper 1/3, 20% of the times where markets could trade at or where the tech sector could trade at. So even if we go to a broader sampling of tech, not just the most speculative types, the multiples in these faster growing companies are extremely rich. So this does tell us that we've got some more noise here in the NASDAQ profile of trading. This comes back though to, when you look at, in terms of positioning though, now we've talked some big picture stuff in terms of stocks versus bonds. We've talked a little bit about the nervousness in the market, the interest rate backdrop. Now, how do we sort of like fold this into positioning? And this is where we're going to get in a little bit into the sort of barbell arguments we've been making. And so when we look at the profit cycle, I think that's always going to be the sort of anchor to the framing of your portfolio. When we look to that world, what we'll notice is that we've had this sort of incredible 18-month, almost 2-year rebound in the profit cycle as we've witnessed the pandemic go from its full state into the relaxed, recovering mode of the pandemic. And what we're noticing is that those rebound and top line growth are historic, and they're unlikely to remain where they are. And this is what leads us to the next phase, because if you look at sell side forecasts, those numbers have begun to turn lower. earnings expectations are starting to soften. They're telling us that the growth rates for the average firm are going to start to come down. So you've got these sort of like crosswinds that are really working here. One is just the increased costs that we're witnessing because of the supply chain issues. Two, we're looking at the spike in commodity prices. So that's going to further squeeze commodity groups. And three, we're also looking at a rate of change problem, which is that you're coming off of the most easiest comparison, which was in the depths of the shutdown in the pandemic. So those elements roll together and they're going to start to really impact the profitability or the growth rates of earnings. So as that trajectory starts to come down, and clearly we've been framing this out for a while, it is a world where higher quality stocks should matter because margins are going to matter more, cash flows matter more, and yes, valuations are going to matter. If we look at the other elements here, we've got to sort of respect that, the credit markets are going to probably be, the beacon in all of this, which is we've got to watch them. So we're looking at a world where currently credit spreads are still in a historic frame fairly benign. In other words, they are well within a reasonable boundary. The US, for instance, the credit markets here, they were bottoming at a 300 basis points of treasuries. They've now come back up almost 100 basis points in the last 2-3 months. That said, the 400 basis point level is actually the low end of the range looking back for decades. So where we're at is still a reasonable place for business to continue to function. And that's why we keep coming back to this idea that risk assets still matter, even though we're fairly nervous right now. And there really are a lot of uncertainties that are here. One of the points we flagged earlier was this quality bias should continue to work. The bottom line is this thing, the focus on higher quality, more earnings visibility firms, this rotation began over a year ago. And so we have begun to witness quality firms really dominate the performance picture. Some of this is a little misleading, the idea that, the relative performance looks great, but underneath it, what's really been going on is the market's been hammering away at the sort of most speculative tales of the marketplace. As a result, one way or another, quality firms have been dominant. And so that does raise the question, are we concerned that, wow, after a year of higher quality outperforming this much, should it continue? And one way to think about this is to think really about the sort of valuations of quality firms. And so when we look at it in our work, what's important to recognize is that the multiples that quality firms typically trade in, they still are selling at the lower rung historically. So in other words, what we're witnessing is really firms that have been ignored for 2 or 3 years, because if you go back 2 or 3 years ago, what happened? Well, we ended up having sort of a runway market of high speculative growth stocks. In that world, quality growth, earnings visibility really gets left behind, even though that's still labeled in the growth camp. Then going into the pandemic, this became, in fact, more aggressive. Taking it further, though, what happened from there was that you ended up getting the discussion and the hopes and then ultimately the delivery of vaccines. So that created this massive, so you went from like super speculative names to this massive deep cyclical rebound reopening trade. So what happens? You end up ignoring quality firms for almost 3 years. And so that's really by 2021, that really set up the game to focus on earnings visibility again, just because we thought the law of large numbers are going to come into play, that if you're rolling over 12, 15, 18 months worth of a bottoming in the profit cycle, things should, by definition, your easiest comps are behind you. So things are going to slow. What we did not factor into all of this thought, though, was on top of the supply chain issue getting worse, not better or improving a year, 18 months later, is this shocking moment with the Ukraine invasion and everything that falls out from that between commodities, uh, not just crude and gas, but also grains. An important side note in the quality discussion and debate has been, is it a uniform story? Because when we mention quality, I think investors have this tendency to think, oh, you mean food, soup and soaps. And the bottom line is no, not at all. Across every sector, if you look at higher earnings visibility stocks, we are seeing, or at least most sectors, we're seeing higher quality firms dominate. And the performance has been especially strong into growth sectors like healthcare and tech. Why? Because those were where the most speculative firms had really been bid up. And so as those started to unwind, guess what? The firms with cash flow, the more visible earnings, healthcare firms, the technology companies with real cash flows, potentially more of a laggard in terms of long-term growth rates, they've started to outperform. The exception to this, though, and I think it's super important to recognize, is this quality story doesn't hold up so well when you get over to groups like energy materials. In fact, we're seeing the exact opposite there. And I guess this feels about right, because as commodity prices inflate, guess what? Are you really going to chase the safe names in the commodity areas? Or are you going to chase the areas where the top line growth is really going to become explosive? So it's quite possible that quality is a misnomer among the commodity groups. And that's really what our data has been sharing with us. The idea of commodity trends being higher for longer, we're sort of firmly embedded in that view. Part of this is really driven by, one, the supply chain issues that have been long lasting now for over a year. I don't think, and we don't think, they get a lot better. In fact, the Shanghai issue is a little nerve-wracking when you consider that you're looking at over almost 30 million people in that city, and also the sort of production hub of the world. That is likely to create even more chaos in the supply chain framework right now. So when we look at that, in addition to the additional commodities, that the fallout due to the Ukraine situation, and I hate calling it a situation, but when you look at that, it does seem to me and us that that is not a situation that's going to be resolved overnight. And more importantly, the consequences, the fallout from that moment, are going to be decades long. For instance, Europe beginning to revisit and look in the mirror in terms of how did they frame out their energy and their demand for energy and their supplies for energy. Those are things that are firmly now coming under a lot of scrutiny, and there's a lot of change coming. So we think that this is not a sort of like a very short-term event. Sad to say. So let's pull this together. It's very hard to recognize that we're looking at a barbell position, given what we look at when we see the headline risk. You would think that all you'd want to do is own maybe some safe utilities and a few food companies, but quite the opposite here. We do think that when you look at the sharp increases in commodity prices, really their inability for them to really roll over. We think that is something that's going to likely perpetuate a longer and stronger run among some of these deep cyclicals. So what we've got right now is a grittier sort of mix with a fairly higher earnings visibility posture. So that's really the best way I can reconcile this sort of barbelled world that we're in. I think these are tough times. But I also think it's very interesting in the market how, when you look at the details instead of just the aggregate, I think there's some interesting opportunities here given how dramatic things have moved. So to sort of wrap this up, we've had a pullback in speculation and extreme risk aversion. At the same time, we're also facing a market in higher multiples and Fed action. So the bottom line here is that we still think, because the absolute level of rates are still in a really, I think, reasonable zone for companies to continue to do business, it means chase profits. And so, in a profits driven cycle, earnings driven cycle, it's not a sexy returns market. I think we're sort of psychologically setting up for that kind of world. More importantly, though, when you dig deep down into the equity story, I think the barbell strategy really carries a long way, because we have to recognize that the profit cycle is going to slow. In fact, it's going to slow more. And then at the same time, if you can buy into this idea that the commodity surges that we've seen, maybe they're not going to remain at their very upper end, but it's higher for longer. And I think if we live with that, then that's got to force you to do some sort of industrial material energy positioning as well. And so that's really, in the recent reports that we've done, some of the specifics came out in there. It really allowed us to focus on oil services, industrials, and farming equipment. Those things seem to matter. Their coefficients seem to be a lot healthier when oil prices are higher. Conversely, look out for food companies, which is ironic because you're trying to play defense. But the bottom line is that if you've got input prices starting to surge, and they are, the reality is the margins among the foods and grocers are going to get really severely challenged here. And so when we look at some of the food companies, their margins are they're sort of enjoying sort of post-pandemic highs. And so I think there's plenty of room there for adjustments that could go the other way. So, as we're trying to integrate the strategy, what is the action plan here? Look to the reporting season. Our quarterly earnings report, basically the bottom line of that report was, the earnings reporting should be decent. Comparison should be actually quite good. However, the warnings and the caution and the guidance is really going to be where I think some of the stocks are really going to suffer. I think if you're running a business, you had better be smart to get out ahead of this. And I have a feeling that the sort of post earnings reporting season is going to be all about guidance. And we expect that the guidance to really be the place to look out for. In addition to that, in the specific report, we use, how do you navigate the earnings season? We think that earnings risk models, earnings torpedo models, we publish plenty of that. Be happy to, chat about it. That stuff becomes much more useful when everything's not going just right. And we're clearly in that moment. For our clients with a value bias, we continue to urge the use of our higher quality value blends. Why? Because you don't have this sort of true blue deep cyclical moment. You really don't. You're not looking at a profit cycle that's been crushed and about to accelerate. You're looking at this massive peaking of the profit cycle. At the same time, I think the value managers finally get a breath, because the spreads between growth and value, if we're right about the barbelled outlook, the spreads between growth and value will be not very interesting. I don't mean to sort of like belittle the growth value trade, but I don't think the spreads are going to be that important. You have plenty of reasons to see quality growth work. At the same time, the offset there is that you got innovation shares. The more we're scared or nervous about rates, the more the innovation shares are going to get, they're going to continue to pull back. Counter to this, as much as you're looking at a more high earnings visibility world, that's, by the way, a higher multiple world. So the value managers may not have the best of times, but you've got this commodity sort of gritty leadership and industrial skew where, ultimately valuations matter. So I do think the growth value debate, I don't think it's that interesting when we look out the next 3-6 months. And so to really sort of close here, this is a very challenging period. And, at the end of the day, I do think that a lot of the major signals we've looked at, they continue to stay fairly equity friendly. It's uncomfortable to say that, but at the same time, I do think we've walked you through a few ways to think about this outside of just, really getting hit with one headline after another that's just really tough to take. Feel free to reach out to us with calls or emails. Be happy to take questions here. Thank you for joining us today.